International Conference on Accounting and Finance.
Good morning to all delegates present over here. And firstly, I want to express my gratitude to the organizer of this conference for providing me an opportunity for presenting a paper on corporate governance and ethics. Firstly, I am a chartered accountant and I am in practice, so I am not an academician. So, being a chartered accountant, my paper, first what we do is that we are people who are normally accustomed to working in behind the closed doors. So we are not so much vocal and so much expert in giving speech and all these things. And secondly, in our profession, what we do is that whenever a client comes to us, he comes with a lot of problems, this and that, I'm in trouble, then solve it. Now what we do is that we first listen to him, and what we do is that secondly we refine whatever he tell. 90% of his briefing will be a useless thing, and out of that 10% will pick up, and we'll find actually what is his problem, and we make it as simple as possible, and we deliver him our service in a very simplified manner. So my present paper is also, I have tried to make it as simple as possible. So I have done away with statistics, with other things which normally academician does. So my paper is simply a paper on the topic. It is concentrated only on the topic which I have chosen, and with no complication. It's a very simple one. Now my topic is corporate governance and ethics. The first, what is corporate governance? The word corporate governance is composed of two words, corporate and governance. Now, corporate means business form of company form of business. During the pre-industrialized world, economic activity of women were mainly related to agriculture. People used to do trade on barter and otherwise between individuals and households. They used to do business using their own capital. Then, gradually, business began to grow in an organized manner and spread across country and continents. Evidence of local and international trade are found in ancient civilizations like Egypt, India, and Rome. So at the time, what people do was that mainly people economics was concentrated to agriculture and agricultural product, and what they grow, they used to consume it themselves. So the scope of trade was very limited. Now, after the Industrial Revolution in Europe, advancement of machine leveraged the efficiency of labor manifold, which in return resulted in surplus production. Such surplus production gave rise to need for finding new markets for trade. Explorers from Europe sailed across different continents in 15th and 16th century in search of market. With the expansion of trade, a new method of finance were also found out. The most popular among them was formation of joint stock company. The earliest recognized joint stock company was formed in 1553 and named Company of Merchant Adventure to New Land. It has 250 shareholders. The Dutch East India Company is known to be the first multinational company. Now let's come to the characteristics of a company. Now, a company has certain peculiar characteristics which are not found in other form of business. Now, the first characteristic is separate legal entity. Now, a company is separate from its owners. So it has a separate legal entity. Now, number 2 is limited liability. The liability of the company is limited, and the share owners or the shareholders are not liable for the debt or the act of the company. And third is scattered ownership. Now, the company, the ownership of the company are divided into small units, and they are called shares. These shares are owned by vast number of people, and they are called shareholders. Now, the fourth characteristic is separation of management from ownership. Now, since the shareholders are scattered and are large in number, so all of them cannot come together for managing the company. So, what they do is then, in the case of a company, a small group of persons manages the company, and they are selected by the shareholders, and they are called the board of directors. And then the next characteristic is transferability of share. Now, the shares of a company can be easily transferable. It can be transferred in the primary market or in the secondary market. So that means the ownership can be transferred easily. So these are the peculiar characteristics of a company which are not found in any other form of organization, business organization. So, and because of these characteristics, the chance of manipulation also increases, because the person who are in control of the company, called the board of directors, they can take immunity from limited liability concept. Then, because if they do something and the company lost, the shareholder will lose, but they will be immune from the act. They need not have to sell their own house, own property for repayment of the debt of the company. So these characteristics adds to the vulnerability of the company for fraud. And now next come to the stakeholders. In today's scenario, most of the companies do their business in a very large scale, sometimes at national level and sometimes at in international level. There are many multinational companies who have their presence globally. A lot of stakeholders are involved in a company, such as shareholders, government, employee, customer, supplier, and investor. Any wrong decision or malified act of the management of the company may adversely affect those stakeholders. The main stakeholders are like this: the shareholders, employees, government, supplier, customer, society, and investors. Now, in one side, I have given the type of stakeholder, and in the other, their concern. Now, suppose in the case of shareholder, so they are concerned with the profitability, market price of their share, solvency of the company. Now, employee, they are concerned with their job security, rate of payment, retirement benefit, etc. So, I am not going to explain it in detail. So, come to the management of the company. Now, since a company is an artificial person, it cannot take decision of its own like a natural person. Therefore, the decision-making power of a company is entrusted in the group of people called board of directors. The board of directors take all the decisions, both for day-to-day activity as well as strategic decisions on behalf of the company. The board of directors, all the resources of the company are at the disposal of the board. It delegates some of its power and responsibility to the chief executive officer, called CEO, and through him to its subordinate senior managers and officers. It is essential that the board should have the required integrity and should be transparent in their policies and decisions. The board of directors act as the trustee of the company. So if they want, they can do a lot of mischiefs. So they should be responsive, they should be have integrity, they should be ethical person. Then only the company will function properly. Now, next we come to corporate fraud in recent times. Now see, in recent times, we come across a lot of frauds and corporate collapse which occur in the various countries. Now, excessive greed, integrity failure, tendency to cross ethical boundaries, and ignoring the law of land at senior management level has resulted in many high-profile corporate fraud and corporate collapse in recent years. Here is a list of such corporate fraud. Now, in 2001, in Enron case, the directors and management fraudulently concealed large losses in various projects. Huge debts were kept off the balance sheet, and because of which the Enron became financially bankrupt. And its effect was that about 4,500 employees lost their job. Investors lost about $60 billion in a few weeks. Pension fund of employees were stopped. People's faith in U.S. financial market got destroyed. Then in 2002, in the case of WorldCom, profit was inflated by entering revenue expenditure as capital expenditure. Now see, if capital expenditure, it should go to the balance sheet. Instead of showing it in balance sheet, if you show it in profit and loss account, then profit will definitely increase. So what they do is that they simply, instead of showing them as capital expenditure, they showed it in profit and loss account and increase their profit artificially. And because of that, what happened was that the company became bankrupt. Why it became bankrupt? Because if you show more profit, you will have to pay more tax, you will pay more bonus, you will pay more dividend. But from where? From your capital, not from your profit. So if you continue it for year after year, a point will come when you will become bankrupt. So the same thing happened to WorldCom. Now, in case of WorldCom, about 30,000 employees lost their job. Investor lost about $180 billion. Now, in Lehman Brothers in 2008, what they did is then they hidden about 50 billion loans by showing it as sale. Now the loan should be shown in the liability side of the balance sheet. Now if you show it in income side of the profit and loss account, it's simply one time accounting treatment, accounting entry. If you show it in income side instead of showing it as liability, then what will happen? Your profit will increase artificially. So the same thing what the Lehman Brothers did it. So because of that, what happened? They became bankrupt. Now in India in 2009, in Swetnam case, what they did was that they falsified the accounts to the tune of 1.5 billion. Now what happened was that in the 90s, the financial market was good. So Indian companies, IT companies were performing very good, fairly. And then after the slowdown in US market, their performance started, their turnover started decreasing. Then what they did was that they showed false turnover to maintain the same graph, to maintain the same profit level. So what they did was that they falsely showed more turnover, and it resulted in accumulation of cash. But the cash was not physically present. About 5,000 in India rupees, about 5,000 crore, those they shown it as cash in hand. But that cash in hand was not physically present. So ultimately, the promoter, he had to surrender and he had to say that, see, I have falsified the accounts. I cannot, year after year, I manage it in like this way. But now I am fed up. I cannot do it any further. So do whatever you do. I am surrendering. So in that manner, Ramaningam Raju, he wrote one letter to the board that this and this was the thing. Now I am surrendering. So it's the case. So in all these cases, the main thing is the ethical failure. Now since the time is limited, I'm just passing about some topics. Now, relevance of good corporate governance. So the points I have given, but I'm not explaining them. Procedure for good corporate governance. Now, some of the points I'm explaining. The company may develop a manual for good corporate governance. It is essential to overcome all this type of fraud and manipulation. It is necessary to have good corporate governance in place. Now, what is corporate governance? Now, corporate governance refers to the set of rules, procedures, processes, and principles by which a company is governed and controlled. It refers to the power, responsibility, accountability, relationship, and transparency in conduct of those involved in the governance and control of the company. Main persons who are involved in the governance and control of a company are the board of directors and the management. Now, corporate governance also refers to the relationship among various participants like board of directors, management, shareholders, employees, etc. Now, for good corporate governance, a company, number one, what a company can do is that it can develop a manual on corporate governance principle, documenting the functions and role of the board of directors and its employees. Codify the procedure for appointment of directors so that only person with relevant experience, integrity, and quality get appointed as director. Then, substantial number of directors should be independent directors. Form corporate governance committee. Then, chairperson and chief executive officer (CEO) should be two different persons. Board meetings and shareholders meetings should be held regularly. The company, there should be proper accounting system. There should be proper internal and external auditing system in place. These are some few measures for a good corporate governance. Then, ethics in corporate governance. Good corporate governance does not in itself guarantee success of a business unless the people behind their implementation have required integrity and ethics. Ethics is associated with moral principles and value in action and decision. Ethics and legality is not same. Some act may not be illegal from law point of view, but it may be ethically inappropriate and thus unacceptable to the society. Thus, ethics is the bedrock of corporate governance. Corporate entities, though, are bestowed with many of the legal powers like human beings, but they have no moral sense. They cannot themselves differentiate between good and bad. The board have to embed ethics into the functioning of the corporate entity to give it conscience. The board, being the primary decision maker, they should hold themselves accountable for the way the business is operated and its effect on the shareholder, investor, employee, customer, and other stakeholders. Short-term profit should not override the long-term sustainability of the business. A few typical methods which corporate entities are found to use in recent days and thereby compromising with corporate ethics are as follows. Number one, manipulation of account. Number two, non-disclosure of material facts in the financial statement. Number three, disclosing misleading information and window dressing in financial statement. Number four, overexposure to risky transactions. Number five, paying excessive bonus and remuneration to top management. Number six, diversification of fund in a wrongful manner for some other business. Number seven, tax evasion. Number eight, insider trade. Number nine, transfer of controlling interest to rival entities. Now in conclusion, until last 2 decades, the focus in corporate world was not on corporate governance, but was on management. But recently, after the high-profile corporate fraud and collapse throughout the world, the focus has shifted to corporate governance and ethics. Now it is well established that the mere profit-making is not acceptable as the main objective of a company in modern-day society. Long-term sustainability after discharge of social responsibility and creation of value addition for all stakeholders is more important than profit-making. Governments of many developed and developing countries have also enacted laws for establishing good and ethical corporate governance principles in companies operating in their respective country. After collapse of Enron Corporation, U.S. government enacted Sarbanes-Oxley law in 2002. In India, the new Companies Act 2013 is enacted after Satyam scam. To avoid occurrence of corporate fraud and corporate collapse, it is essential that the board of directors act in a responsive manner. The company should act in such a manner that it is beneficial to all the stakeholders. With this, I want to conclude my presentation. So if there is any question.